Let's head to Uganda now, where the central bank has asked investors holding treasury bonds due to mature in April to now apply to convert them into longer dated tenures, which will come due between May 2025 and August 2042. Now, the bank said the investors holding the bonds maturing in April, which have a coupon rate of 11%, can now apply to convert their holdings to the various longer dated tenures with coupon rates ranging between 14% to 18.5%. Investors are also free to choose whether to participate or not. And these new tenures include a 3-year, 5-year, 10-year, 15-year and 20-year bonds. Now, Uganda has been struggling with a rising public debt pile, but the central bank did not give any reason for the bond switch proposal. Well, let's get more on this. We're joined now by Hannah Ryder. She's the CEO of Development Reimagined, and she joins us now via Zoom. Great to have you with us on the show, Hannah, as always. Now, of course, Uganda's central bank hasn't really given us any reasons for this bond switching program. So one can't help but wonder about a possible default going forward, especially because the cost of servicing its debt was certainly starting to put some pressure on the country's public finances. So what are your thoughts on what's happening here?
Definitely. It's obviously worth looking out for, and it's always important to track these changes. And as investors, you have to care about these changes. At the same time, it's important not to overreact. What the central bank is obviously doing is seeing if there's an opportunity here, an opportunity to defer some of the payments effectively and to kind of to put it in plain English, what the central bank is doing is giving investors the opportunity to go for it, to get a higher return through a higher interest rate and to pay higher interest on the return on the bonds for not necessarily making the repayment today. So there's a cost, of course, to Uganda for this shift, but it just means that the repayments today might be deferred, and so that could make it much easier to deliver on the payments. And of course, from an investment point of view, it's an opportunity. But of course, you realize that, yes, you mentioned the debt servicing has been challenging. It's been challenging for many African countries, as you've been covering on the program, and especially because of COVID-19 and inflation, supply chain challenges, etc. Costs are going up all across the board. At the same time, Uganda is forecast to grow by at least 5% in GDP terms this year. So that should release pressure. That will be more growth than last year, 1% more growth than last year, and then thereafter also continual further increase by another 2% in 2024. So the outlook should be a bit easier, the pressure easing going forwards.
Well, Hannah, let me play a devil's advocate for a moment, because credit rating agencies, they did raise the alarm in the past on Uganda's debt. In fact, they downgraded its debt, I believe. They said Uganda's debt is, in quotes, shorter term, and when borrowed domestically, it's more expensive. What are your thoughts on the makeup of the country's debt stock?
Well, Uganda is in the situation of having to have the kind of debt stock that it has because it is very constrained. Because of the fact that its overall economy is a fairly small size in comparison to others, it's very difficult to raise debt. Creditors are not particularly excited about giving countries more debt when they're small economies. It's that simple. And so credit rating agencies, of course, are more risk averse when it's a small economy. This is simply what they do. And they're also, when they're far away in smaller economies, they also take a more negative view. And it's very clear, there's plenty of evidence that there's a general Africa risk premium being put on African bonds and African bond issuance. It's been proved many times. And so this is sadly a challenge that Uganda has to face, and many other African countries have to face as well. But we have to have finance from somewhere, and we have to find a way to be prudent while at the same time trying to create better conditions for citizens, and that's what a country like Uganda is simply trying to do.
And also, Hannah, you said, like you earlier said, it's important not to panic in such situations because we don't really know, or there may be other reasons as to why the government is doing this. But this did raise a number of eyebrows. So how are you expecting markets to respond to this recent news from the government? How are they responding now?
Well, like I said, it's important not to panic. I do expect markets to respond negatively to it, perhaps a further downgrade. But again, this is to be expected. Again, other countries such as Ghana and so on have had similar challenges. They've spoken out even at a government level against these sorts of downgrades and so on. But it's pretty difficult not to. Effectively, most African countries have to simply deal with it and then try to find a way out. The challenge is that interest rates are expensive. That's why the debt servicing payments are expensive, and especially from the private sector, both domestic and international, much more expensive than bilateral lending. And so that does create significant challenges. I do expect that to be a problem, but nevertheless, if credit rating agencies and others actually understood the situation of countries like Uganda a bit more, I'm sure they would be significantly more forgiving. Unfortunately, they don't.
Mm.